Hello everyone, welcome back to our YouTube channel. We are PGN Accounting Group, and today we have a video called How Much Money You Should Have by Each Age. And we're going to go through how much money you should have at age 20, 30, 40, 50, 60, and the ripe old age of retirement, 67. But before we get into the video, please hit the subscribe button. Follow us on Instagram, and if you want to set up an appointment, it's still tax season. Taxes are due April 18. It is not too late to book an appointment, so if you want to book one, go to pgnaccounting.com and book one with us today. Now back to the video, how much money you should save by each age. But before we go and start with how much you should have by age 20, I want to do a little reality check. For those that are depending on Social Security when you retire at age 67, doesn't matter if you're 50 right now, it doesn't matter if you're 60 right now, or you're 20. It doesn't matter your age. If you're depending on Social Security, this is a wake-up call. It's not gonna be enough to retire on. You're gonna see, if you go to my Social Security Administration website and you calculate how much you're going to receive at the age of 67 and age 70, you're going to see it's going to be on average about $1,700, $1,900 a month. Now, if you do your budgeting and you see how much money you really do need to cover your expenses, you're going to see, wow, that is not going to cover even half of my expenses. Unless you want to live a very dull, boring retirement life, eating ramen noodles every day, do not depend on Social Security. It's not going to be enough, and you're not going to enjoy life if that's your sole retirement income. Now, if you're also depending on a pension from a company, another reality check, most companies do not offer pensions. Now, there is an exception. If you work for the government, they have some nice pensions. But other than government employees, most employees of companies do not receive a pension. So what does that mean? You're going to have to save for your own retirement. It's not a big deal. I'd rather actually save for my own retirement because I'm disciplined. And if you're disciplined like me and you want your retirement in your own hands and you can actually control your retirement money of what it's invested in and how much is left over when you die so that you can hand over to your kids, then you don't want to depend on Social Security. You don't want to depend on a pension because those go away after you die. But if you retire and you die and you had a 401k or a Roth IRA, you get to hand that over to your kids. It doesn't just go away. But also, Social Security and pensions, they're not invested and growing at a rate of 10% on average like your retirement is. Your own 401k and your own Roth IRA. Those are growing on average. If they're invested in an S&P 500 ETF, they should be growing 10% per year. I'm not going to go over that in this video, but I did want to do a reality check before we go into how much you should save by each age. And if you want me to make a video based off of that, of going into a little bit more in detail on retirement, then please comment below and I will try to make a video on that as soon as I can. Savings by age 20. Now, most of the people by the age of 20, you probably have a negative net worth at this point. You probably don't have much to your name because you're going to college, racking up student loan debt. You have a car debt. You didn't really have that many working years in you yet, especially if you started at the age of 18 or 19. You finally started getting an internship, working part-time job, started putting away some money. So at this point in your life, I'm not going to say how much you should have because if you have anything, you're ahead of most people in your age group. So save as much as you can and start early in your retirement because every dollar you save at age 20, it will be worth $88 when you retire at age 67. So that compound interest is really going to work nicely for you because it's going to be able to grow for 47 years. So start early and invest as much as you can. For example, savings by age 30. You should have at least 1 times your income, and that's gross income. So if you're making $60,000 per year in your salary, you should have $60,000 in your savings. That way, it's a good benchmark. If you're a little bit over, a little bit under, it's okay. You still have 37 years before retirement to really put away savings. But again, put as much as you can. I suggest you even do more than 1 times your income at this age, because you have another 37 years of compound interest to let that grow, double up every 7 years. So by age 30, you should have at least 1 times your income. By age 40, you should have 3 times your income. For example, people in their 40s are making on average, in the US, they're making on average $80,000 per year. So they should have $240,000 in savings. Now this is kind of the halfway point. If you're not really putting away in savings, then you should really double the amount of retirement contributions a person that has been putting away is putting away per month. For example, if somebody's been putting away from 20 to 40, they've been putting away $500 per month into retirement, but you at 40 have not, then you should be putting $1,000 or more into retirement so that you could catch up to where you should be at your age. Unfortunately, you're going to have to probably do double or triple so that you could catch up to that person that has been already investing for 20 years. But that's how powerful compound interest is. Yes, $240,000 of savings at the age of 40 sounds like a lot, but you shouldn't rely just on how much retirement contributions you're making. You should rely on the contributions plus the time that it took for those investments to grow. Again, if your investments are in the S&P 500, on average, make about 10% return per year. Some years are 20%, some years are negative. I understand, but on average, it should be making 10%. And if that's the case, then your money should double every 7 years. So you're not just relying on how much money you could put into retirement. You should be relying on the growth potential that it has. By age 50, you should have 6 times your income. So this is double from age 40, where we said 3 times your income. By age 50, you should have 6 times your income. So if you're making about $105,000 a year, you should have $630,000 of savings. Now again, let's say you had 240, you're right on track. That's a 10-year difference. In 7.5 years, your savings should have increased 1.5 times because it should have doubled and then some. Again, we said it should double every 7 years. So that 240 should be about $630 in savings. Now, again, you're still contributing. So you'll easily hit that $630,000 of savings if it's invested in the proper ETF. So an S&P 500 ETF. Then you should be able to hit these benchmarks. By age 16, you're right at the finish line, almost about to hit retirement. You should have 8 times your income. So if you're making a $140,000 salary, your prime earning years of between 50 and 60, you're making 140, you should have $1.12 million of savings. This is a nice nest egg. You should feel safe and secure that, okay, I'm going into retirement 7 years from now. My house is paid off. I have no debt, no car loans, no mortgage, nothing. But I have a nice $1.12 million of retirement savings ready, waiting for me so that I could enjoy retirement peacefully and comfortably and not relying on Social Security. Social Security is the cherry on top of this $1.12 million of savings. Now, congratulations. Happy retirement. You hit 67 years old. Now, by this time, you should have 10 times your income. So if you were making $150K at the end of retirement at age 67, you should have $1.5 million of savings. That sounds like a lot, but again, if you're investing from the age of 20, 25, let's say you started a little bit later after 25 when you got your full-time job, if you're investing 15% of your gross income into a Roth IRA, 42 years from 25 to 67, you will have substantially more than $1.5 million in savings. These are benchmarks on the average of what an American makes at each of these ages. And this is a nice benchmark so that $1.5 million is a lot so that you could save comfortably. But you should have way more than this if you were disciplined from your 20s all the way up until retirement. And you were diligently putting away money into retirement every single paycheck, every single year, not stopping, but actually increasing it. Then you would have substantially more than $1.5 million. You wouldn't need your Social Security. You wouldn't need a pension because you are insuring yourself for a nice, ripe retirement. You don't have to depend on the government. You don't have to depend on a company. You depended on yourself. And congratulations, because most people don't. If you do this, then you are ahead of so many other people at retirement. So congratulations. Bonus. Where should I put money for retirement? That's probably what you're wondering throughout this whole video, because I mentioned 401k, I mentioned Roth IRA. And you're probably like, what are those? I heard of it from my work, but I don't really know what it is. So I will make more videos on where you should put your money for retirement. And if you want me to talk about specifically what are these vehicles for retirement, then comment below. But these are some places that you could put money for retirement. It's not just your 401k. You could put in a Roth 401k, which is after-tax dollars, so you don't have to pay for it later. Traditional IRA. I recommend the Roth IRA and the Roth 401k because those are after-tax dollars growing tax-free, and then you don't have to pay tax when you retire. That's amazing. And so many people forget about this, but please open up an HSA. It's a health savings account. I don't care if you're healthy right now. Well, I do. I want you to be healthy. But I don't care if you're not really spending on medical bills. Oh, I don't really need an HSA. Why am I going to put $3,800 or $7,500 into an HSA every year when I'm healthy? Because when you get older and you have kids, it's inevitable that you're going to have out-of-pocket medical expenses, and especially when you retire and get older. So this HSA is triple tax advantage. You get a deduction when you put it in, it grows tax-free, and you take it out tax-free. So use this as another retirement vehicle for when you hit 67, and you could withdraw on it to cover your medical expenses. Now, if you're self-employed, you could have a solo 401k, or you could have a simple IRA or a SEP IRA, or if you're making a substantial amount of money and you want to put a substantial amount of money into retirement, you could even open up a deferred compensation plan. Now, if you are self-employed and you want to know about these, please go to our website, pgnaccounting.com, and book an appointment with us, and we could help set up these retirement accounts for you. I know some of you probably are feeling not so good because you're 30 and you don't have that much in retirement savings, or you're 50 and 60 and this is probably a wake-up call that you were trying to depend on Social Security and it's not really going to be there for you, or it's not going to really cover much of your retirement. I'm sorry that you reached that age and I made you kind of feel bad, but please take this positively and encouraging yourself to start this being more disciplined and putting away for retirement. Please start doing it. The best time to plant a tree was 20 years ago, but the second best time is today. So it's never too late to start saving for retirement. Yes, you might have to put a little bit more than somebody in their 20s and 30s, but it's still possible. Even when you're in your 50s, it's not too late to save for retirement. So please contribute to your retirement. Do not rely on the government. Do not rely on a company's pension. Rely on yourself, your hard work, and your discipline to ensure that you have a happy, comfortable, peaceful retirement. And if you liked our video, please hit the subscribe button, follow us on Instagram, go to our website, pgnaccounting.com, book an appointment with us today. See you guys on the next video. Thank you.